Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future today, because 'tis the season, right?
It is.
The season is upon us of Christmas time. In fact, it's Christmas Eve.
Yes.
That's something joyful, and I'm excited about
yes.
that. So we are going to be discussing the phenomenon known as a Santa Claus Rally.
Yes. Every time I picture that, I see people in the streets with picket signs, no more coal, being good is relative, those type of things. That's the Santa Claus Rally, right?
They're I was thinking of something about eating too many cookies where you just rally around your teammates and you just plow through that plate of cookies. So anyway, nice try. It is cookie season. It is Santa Claus season. However, dang, I'd eat a cookie right now. Why do we always record this when I'm hungry?
You're always hungry.
So I am always hungry. So it is cookie season though.
Yes. So what are we actually talking about? So a Santa Claus Rally is a term within the financial industry that relates to this time of year.
You are not wrong. So when the markets perform well, generally up, so in a sustained move during the last week of December and the first couple trading days of January, this is called a Santa Claus Rally. So there are a number of reasons why this does or can happen. So number one, tax considerations. Yes. So suppose at the end of the year at some point, you harvested some losses, but you still wanted to participate in the market, so you took your money and bought something else.
Yep. And we actually talked about that in an episode.
So if you want to learn more about tax loss harvesting or tax planning in general, we'll link an episode that we just put out in the show notes for that. But when you do that buying something else, that buying causes stock prices to go up.
Yes.
So that's one reason that could be causing what happens often, in the markets around this time of year. Another one is when people buy. So like I said, buying makes stock prices go up. Buying, anticipating what's another phenomenon called the January effect.
Man, there's so many.
I know. So really, the January effect is when people are buying back in early in the year, sending prices up after harvesting losses at the end of the year. So there's like two different ways you can look at it, but it's all tax related at the end of the day. Those couple options of why this could be happening.
Are we going to do an episode on the groundhog effect where you just keep buying the same thing over and over again?
Well, if you're buying, it's always a good time to buy. So another reason that you could have what's called a Santa Claus Rally is just general optimism about the market. And, as we're sitting here in 2020, the market's doing okay.
Yeah.
I mean, all things considered, with COVID going bonkers and things not looking great on that front, the market's pretty healthy. The market's at all-time highs, and everything seems to be working pretty well in the markets right now. So
we're seeing the rollout of the vaccine. I think Europe's already been handing that out. And so the idea there is, as we head that direction, more and more people are getting that protection to help hopefully reduce the number of cases and deaths especially.
Another potential reason is actually the investment of holiday bonuses. So a lot of, and most, traders and managers on Wall Street specifically, they're paid pretty substantial portions of their salary in the form of bonuses at the end of the year. That's based on a couple factors. Number one, market performance, which isn't really anything they can control.
Yep.
But if the market had a good year, then their business probably had a pretty good year as well. And B, likely business performance. Maybe they executed well as well. So when those traders get this income, most of them feel, the best use for at least a lot of it is in the markets. So when you put that money in the market, that's again buying. And when you buy, prices go up.
Yep.
So I also think if you would have told anyone on Wall Street that we would have, this crazy stock market comeback and stocks at all-time highs, in the midst of a COVID pandemic, that they would have laughed and said, when you said that they were probably going to get a decent bonus, like all the traders on Wall Street, they were going to be like running for the hills.
Yes.
But it actually turned out to be probably a pretty good year for a lot of investment bankers and stuff like that.
Definitely.
All right, conspiracy theory time. Some believe that this also occurs because many of the institutional investors, the larger institutions, tend to take time off this time of year. Maybe they'll go be with family in their lake house, or probably not their lake house, maybe the beach.
Yeah.
Probably not a lake.
Unless it's a lake
like a lake in the south.
Yeah.
Yeah, so a lot of these guys might take some time off, and these large institutional investors are typically more bearish than your retail investors or your smaller investors, and those retail investors are the ones driving the market during that time, and that's going to bid prices up as well. So that's like not proven, but that's a theory.
And I subscribe to the idea that people's attitudes are a lot better right now as well. So the concept of like you talk about the more retail investors, but you're in a holiday season, you're buying presents, you're seeing family in most normal years.
Right.
You're in a good mood. And so I think that attitude plays into your optimism, and it pushes you to say, you know what, I do think things are going better than I would have probably thought midway through the year or something.
And optimism bids
huge.
Prices up.
Oh yeah.
So it's wonderful.
All right. Let's pause. So now we know what the Santa Claus Rally
True.
is. So let's take a dad joke break.
Is this like your Christmas present to me?
I got a dad joke for you, and it's more of a question. And it's probably relevant because I need to know. What do you get someone who has everything? A burglar alarm. Because they have everything. You don't want them to steal anything. You need a burglar alarm.
Oh, that is so funny. Yes, that is.
Because if you have nothing, what are you protecting?
There was this.
It has everything.
I don't remember what show it was on. Rules of Engagement. That was an old show that used to be on.
That was a funny show.
So David Spade and Patrick Warburton, fun fact, they're hilarious. They are Cusco and Kronk on Emperor's New Groove. So when you watch that now, you're like, dang, this is even better. But I forget one of the other.
His dry sense of humor is hilarious.
Yes. And he's got the
voice.
And it's so funny. But the younger couple, I forget their names. I can picture them, but I forget their names. They had their house robbed, and no one stole anything because they had nothing worth anything. I thought that was really funny. So back to the Santa Claus Rally. So let's talk about some statistics over this period of time, and it's kind of funny. So I was looking stuff up for this and preparing for this episode, and I found some statistics, and I was like, okay, this is great from Investopedia. But when I added up the numbers, they didn't hang. So we're going to link this in the show notes, and I had to manually calculate some of these myself. It was interesting. So since
it's due to rounding, and then
due to rounding, it's like a big asterisk you can put on anything. So since 1969, this period that we've been talking about, so like the week leading up to Christmas into the first couple trading days of January, has generated positive returns 36 of the past 50 years.
Okay.
So that's 72%. That's pretty good. That's actually more than average.
Yes.
And the average return over this period has been around 1.4% cumulatively over that time, with positive returns typically in all 7 of those trading days during the rally.
Interesting.
Now, if you remember, I'm thinking like 2018 most recently.
That was not good.
Not a good last couple days of the year. So that's one that took down that statistic a little bit. But overall, generally pretty positive. So I guess that's kind of where we're at.
Yeah. So what do you think this year then? I mean, we had a pretty crazy year. COVID is still here. What do you think? What are your predictions?
I mean, I'm going to put the disclaimer out there like I probably should that I don't know for sure what's going to happen, and anyone who does should probably be fired.
Yeah.
But also, I can say that the market has done things that were unpredictable this entire year, from a sell-off to a rebound to all-time highs. Some of those things just haven't really made a lot of sense. But overall, I think sentiment, how people feel about what's going on in the market and the health of the market and things like that, and having kind of a light at the end of the tunnel with vaccines and stuff like that, I think is pretty good. So I would not be surprised if we got, there's no guarantee, but it wouldn't be surprising to me with kind of the way the market's been handling itself lately if there was a Santa Claus rally at the end of the year. Do you have any thoughts on that?
Like you said, with everything going on, it really just takes one news headline to move it either direction. And so I think this year has the most volatility when it comes to headline risk for our Santa Claus rally, up or down. But in general, like you said, with everything moving the right direction, I think, probably 72% chance that it happens.
Rough, plus or minus.
Rounding errors. Just historically speaking, I just think there's a good chance unless, you get something weird happening.
So, Josh, what should listeners do during this period?
Yeah, so this period is the same as any other period in that you should really just have a plan with your financial advisor. And so, when we're talking about a Santa Claus rally, we're really just talking a handful of days. And if you're a long-term investor, it's really irrelevant.
Right.
You're really not. You shouldn't be trying to time in and out of the market based on those type of trade. I don't even know what you call it. Theories, as Santa Claus phenomenons. Yeah. So in general, if you have cash and you have a long-term mindset and you have the ability to take risk, is now a good time to invest? Yeah. So was 2 weeks ago.
Exactly.
So was 3 years ago. I think long-term perspective just means get the money in and get it compounding.
Timing this potential or could or could not happen Santa Claus little rally, this little 1% bump maybe at the end of the year or whatever, it's inconsequential.
It is.
In your 30, 40, 50-year plan. Yeah. Even shorter term,
And you may be participating in it without realizing it. So like we talked about in the tax loss harvesting, if that's something you do at the end of the year to generate that, chances are you're buying a placeholder and doing kind of what we're talking about here and helping to kind of boost that Santa Claus rally.
I would probably advise that you should not count on this to be a game changer for your financial outcome.
Yes.
Because
if you need this to...
Don't risk the house on a Santa Claus rally. Yeah. That would be quite unfortunate.
Yes.
So yeah, like you said, if it was a good time before the end of December to buy stocks for your financial plan, it probably still is regardless. Yes. So just keep doing what you're doing, and really how you navigate all of these potential Santa Claus rallies and January effects and
the February
rallies,
Groundhog Day, where you keep buying the same thing over and over.
Exactly.
Made that up.
I know. You're gonna get a little rights reserved copyright.
I need
Josh Robb. What you do is you set up that automatic, systematic investing where you put the same dollars or percent or whatever it is into your account every single month, and you just don't think about it. Just let it go. Yep. And then you'll either. Some days you'll buy it when it goes up. Some days you'll buy it when it goes down. But at the end of the day, you're buying it a long time.
And you're averaging it out.
And you're going to compound. So, yeah, that's kind of our advice is don't count on the Santa Claus rally, whether we get one or not, to make a difference. However, it'd be great. And everyone would love to see a nice little bump at the end of the year. Yep. So, yeah, if it's time to buy stocks for you, it's time to buy stocks for you.
That's right. All right, so thank you very much, Austin, for filling us in on the Santa Claus rally. Sometimes we forget that there's these terms in our industry that maybe people hear and don't understand or aren't as familiar with because they're not living it day in and day out. So if you guys have any questions or thoughts or you hear something like that and want to know, hey, what is that? Shoot us an email at hello@theinvesteddads. We'd love to talk about those topics. Austin, what else can they do?
Yeah, well, first of all, as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. It's free. It's a nice PDF. It's on our website. Check that out. You can also subscribe. We'd love it if you'd subscribe, and then hopefully you can get an alert when our episodes come out every single Thursday. We'd really appreciate it if you'd leave us a review specifically on Apple Podcasts because that will help us to show up in rankings and help a lot more people out. Yeah, and if you liked this episode or had someone asking about
or
what this
Santa
is,
and he was asking,
he might have been asking. Share this episode. Click that share button. Share it with friends and family. Otherwise, just tune in next week because we'll have another one.
Yep.
Merry Christmas. Merry Christmas.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.